In the crypto markets, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived. The algorithms and the quantitative strategies, we believe, are going to be wrong once again. We're all in, and my conviction couldn't be higher.
Not one to shy away from a contrarian viewpoint, Cathie Wood and her firm ARK Invest believe we are about to undergo a major shift in both equity and crypto markets in 2022. In her latest breakdown, Cathie Wood explains why the majority of investors, as well as algorithm and quantitative traders, have got the market completely wrong. In this video, Cathie breaks down the current macro environment and why, although everyone is betting big on inflation, the more likely outcome in 2022 is deflation, which would be very bullish for risk-on assets such as Bitcoin, Ethereum, and innovation. Make sure to stick around to the end of the video where I will analyze Cathie's breakdown to see if she's got it right. Also, I will cover why this Wednesday is going to be pivotal in determining which direction we see markets head over the next few months. Finally, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
Well, today we have a very different point of view, once again, about what's going on out there. And so that's why we do these videos, and I will get into that in a moment. First, I'd like you to alert you to a blog that I wrote in mid-December. It's on our website. And it goes into why we believe that innovation is in deep value territory, and goes through and refutes a lot of what we believe are the myths out there about innovation. We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research. And I'm going to give you a few examples of that in a minute. I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you between the company and ARK funds, which are more than half of my IRA, and the significant percentage of my total net worth. We're all in, and my conviction couldn't be higher that the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable, and the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms, they're going to cause a lot of problems for the underlying economy, the traditional world order. And I'll explain a little bit more about that in a moment. So what has happened is in the early stages of the coronavirus, when I was doing those videos, we had algorithms and quantitative strategies focused on just a few variables. They were at that time cash burn and cash cushion. And a lot of our stocks did not have big cash cushions and were burning cash, especially in the genomic space. And they were taken down by 75%, many of them, in a month, just in a month, 3 weeks to a month. And of course, that was the wrong answer. The algorithms got it wrong, and that there was a massive head fake, caused a lot of consternation for the quantitative strategies out there. Because, of course, genomics was a big part of the solution to a problem we were facing in the coronavirus. What has riled the market in the last week or so is Fed minutes being released suggesting that the Fed is going to become more aggressive at raising interest rates, perhaps sooner than many expected, maybe in the March timeframe. Now, what we believe has happened here is that the Fed, having suggested that inflation was transitory since the beginning of the coronavirus, was becoming concerned when it saw CPI inflation, headline inflation, year over year at 6.8%. And it does not want to be blamed for inflation being sustained and certainly not moving out of control. We think this is a bit of jawboning here. We think that some of the economic statistics that I'm going to share with you in a bit, the Fed knows very well. And those statistics suggest that inflation is indeed transitory. But on the off chance, and I'm sure there's a big debate going on at the Fed, there are going to be some Fed governors and Fed presidents who are looking at statistics and are citing some that are still on their way up. There are others who are going to be citing statistics that are on their way down, but they want to, on the side of hawkishness or being too tight right now, certainly from a jawboning point of view, because they don't want inflation to continue to escalate. We see M2 growth still around that 13% range, having peaked at 27% in March of 2020. So the deceleration is there, although it's leveled out at 13%. And what we think is quite significant is this concept of velocity, which means that money growth is faster than GDP growth. That velocity going down, we think is beginning to reassert itself, which would be anti-inflationary. Again, we have to wait for more statistics to make sure we're right on that. But we do think that M2 growth is higher than GDP growth, which means velocity is continuing to go down. If velocity were starting to go up, meaning the rate at which money changes turns over in the economy, if that were starting to go up, that would be an inflationary signal. We're not seeing that. In the crypto markets, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived. We think that we're in a period of innovation that was the dream in the late 90s. But those companies were vaporware. They were based on nothing but eyeballs. We have real revenues. We have incredible growth rates. And if we're right and the economy has an inventory problem, then our growth rates are going to look far superior to anything you'd find in the value space. And we are really looking forward to that.
So there's Cathie Wood on why she thinks the current sell-off we are seeing is going to be short-lived and why the majority of market participants have got it wrong. For those of you who are left scratching their heads at why deflation would be bullish for crypto markets as well as innovation stocks, let me break it down. Over the last few months, because inflation data coming out has continued to be higher than expectations, it forces the Federal Reserve to do something. They have two main tools to combat this. They can raise interest rates and they can also stop quantitative easing, in other words, stop printing money. Now, because inflation has again and again clocked in higher than projected, the Fed over the last few months have indicated that they are looking at potentially 3 rate hikes in 2022, as well as a speed up in their quantitative easing. This has caused massive sell-offs in risk-on assets such as innovation stocks and Bitcoin, Ethereum, and crypto markets. Now, the reason Cathie speaks on this Wednesday as being so pivotal is because we are going to get the inflation figures for December. The CPI number that is forecasted is 7.1%. If we see inflation higher than this, it is likely Cathie Wood is wrong about deflation and we will continue to see sell-offs on risk on assets such as crypto. However, if the CPI comes in lower than predicted, it is likely that Cathie Wood is correct with her deflation thesis and the Fed will again turn dovish, meaning we will likely not see rate hikes and quantitative easing in 2022. So all eyes on Wednesday to see which way we're heading. Anyway guys, hope you enjoyed today's video and that provided you with some value. I'll see you all in the next video, and as always, have a great day.